Welcome back to the Deep Dive. We take the reports, the analyst notes, and all that market chatter on the companies you follow, and we give you the actionable, well-informed perspective you need.
And today, we're doing a really critical follow-up on a company we've been tracking all year, Allianz Malaysia Berhad, or Allianz.
We have been tracking them, haven't we? I mean, we looked at their tough Q4 2024 results, where that dividend was a huge question mark.
A huge one. And then we followed them through Q1 and Q2 of 2025 as they were, navigating some pretty significant regulatory risks and that rising medical inflation we kept talking about.
So our mission today is simple, but it's crucial. The latest 9-month results are out, and, well, they look stellar. We need to unpack how they pulled this off.
Figure out how they actually tackled those industry headwinds we were so focused on.
And most importantly, determine what this newfound financial confidence really means for their dividend policy and, their future growth.
It's time to see if those strategic promises they made at the start of the year have actually, materialized.
Absolutely. But before we jump in, if you value these deep dives and honestly the shortcuts they provide, please do us a huge favor right now.
Just take a second.
Hit that like button and subscribe to the channel. It really helps us focus all our efforts on bringing you this kind of analysis.
It makes a big difference.
Okay, let's start where you started. One of you listening noticed a massive movement in the stock recently, and you were completely spot on.
Yeah, that volume spike on November 26th was huge.
What were the numbers? Something like 832,500 shares traded. That's nearly triple the average. The price closed at RM 18.54 that day.
And now, as we're recording this on December 1st, it's sitting even higher at RM 19.50.
So that surge, it wasn't just random speculation.
Oh, not at all. That was the market immediately recognizing a significant financial event. That activity, it correlates directly with the release of these very strong 9-month earnings reports.
And the wave of analyst upgrades that came right after.
Exactly. This was a substantial earnings beat, and it kind of validated the operational strategy they've been working on for months.
All right, so let's unpack that core financial snapshot, the numbers that drove all this enthusiasm.
Well, the group's performance was, to put it mildly, way ahead of estimates. Net profit for the 9 months climbed to RM 661.25 million.
And what was that compared to last year?
That's up from RM 540.02 million in the same period last year. And if you look at the core numbers, which is what some analysts focus on, MBSB Research pegged core net profit at RM 695 million.
That's a 29% increase year on year.
29%.
That's not just growth, that's accelerated growth. And I'm assuming we see a similar story on the top line.
Absolutely. Group revenue rose significantly to RM 4.63 billion, up from RM 4.15 billion. So what this tells us is that they're expanding their premium base.
Right.
And at the same time, they're managing costs and underwriting risks so effectively that a much higher percentage of that revenue is just dropping straight to the bottom line.
Okay, and this is where the real insight is, right? In the operational excellence, because Allianz Malaysia is really 2 core businesses.
That's right. For anyone who might be new to the company, you have the general insurance side, AGs, which covers things like motor, fire, commercial risk.
And then you have the life insurance side, Allianz, which is their long-term medical and savings arm. Let's start with AGC, the general segment. That's always been their reliable engine.
And it didn't just perform. They really took the competitive high ground here. They maintained their market leadership in the motor segment, which is crucial, and pushed their market share up to 24.2%.
That's a 1.2 percentage point jump.
It is. And the really impressive detail here from the sources is that AG captured almost half, 46% of the entire industry's motor growth.
Okay, so how do they do that? How do you take that much share? Is it just deep discounting on price?
That's the critical question, isn't it? Because to absorb nearly half the market's growth, it really suggests a competitive edge that goes way beyond just simple pricing. It points to superior efficiency. I mean, it's likely driven by their digital platforms, their streamlined claims process, and a really targeted distribution. They're just making it easier and faster than their competition.
And they're also diversifying inside that general segment, too.
Yes, both motor and non-motor premiums grew faster than the industry average. And their non-motor focus is pretty smart. They're targeting specialized commercial policies, for high-growth sectors like data centers.
Data centers, okay.
And a renewed push into residential fire insurance.
So given Malaysia's climate, risk management is everything, especially when you're heading into monsoon season. What are they doing to avoid a major claims hit that could sink their profitability?
Their approach is very proactive, which is, a sign of strong operational discipline. They're systematically seeding out the higher risk policies to
So
reinsurers.
passing off the risk.
Exactly, passing that potential catastrophic risk off to third parties, and they're increasing their claims reserves. These steps protect their balance sheet from any big unexpected weather events.
And we can see that discipline in a key metric, the combined ratio. What did that look like?
It was excellent. The combined ratio for the 9 months hit 87.6%.
So just to clarify for everyone, the combined ratio is all your expenses and claims divided by your premium income. Anything under 100% means you're profitable from insurance alone.
Right, before you even factor in any investment income.
So why is 87.6% considered so healthy?
Because the industry average often hovers somewhere around, 90, maybe 91%. So running 3 to 4 percentage points leaner than your peers gives you this significant, enduring advantage on profitability. It means their risk selection and their cost control are just top tier.
Okay, now let's switch to the more challenging engine, ALIM, the life insurance side. In our previous deep dives, we flagged medical inflation as the biggest structural headache for them.
It was the big one.
So how did they solve that problem enough to post these strong results?
This is where strategy really meets execution. Medical inflation in Malaysia has been rising so fast, and insurers have to choose. Either lose money on policies or hit customers with really unpopular premium hikes.
A tough spot.
It is. ALIM chose a middle path, strategic repricing through co-payment insurance policies.
And can you just quickly clarify how co-payment works? What's the benefit to Allianz?
The mechanism is really effective. Co-payment just means the policyholder agrees to pay a small, fixed percentage or amount of the claim costs themselves.
Right.
The magic for the insurer is twofold. First, it makes the customer a little more prudent about seeking care, which cuts down on unnecessary claims. And second, it just reduces the overall claims burden on the insurer. And for ALIM, this translated into a much better claims experience overall.
And the report said there was a strong take-up of these new policies, which is kind of surprising. You'd think customers would resist any change that shifts costs onto them.
They managed that transition really smoothly, and that speaks volumes about their communication and the trust they have with their customers. The result is better margins. ALIM's margin expanded from 16.4% last year to 18.7% this year.
Wow.
That margin expansion, driven by better underwriting, it just confirms the success of this entire strategic maneuver against a really powerful industry trend.
And despite all the negative noise in the medical insurance sector, their customer loyalty seems to be holding up.
It is. Their persistency ratio, that's the measure of customers who renew their policies, it remained broadly stable at 84%. To maintain that level of retention while you're rolling out these kinds of changes, it just proves they're executing without alienating their client base.
Okay, let's pivot to the catalyst that really got the market excited, the thing that drove that volume spike, the dividend shift.
Yeah, this is the big one.
We all remember the caution and the skip dividend from Q4 2024. What happened? What led management to adopt this sudden, much more optimistic tone about increasing payouts?
Two things, really. First, that regulatory cloud about capital requirements that was hanging over the whole industry a year ago, it's largely gone.
Okay.
Management now has what they call better visibility, which basically means they're confident they know what capital they need to hold, and they can comfortably project their surpluses.
But is it just about distributing capital they already have, or are they distributing higher quality earnings?
It's the latter. It's definitely the latter. The operational excellence we just talked about, that 29% jump in core profit, the margin expansion in life, it means they have a much larger earnings pie to distribute from.
And the analysts noticed.
Oh, they definitely did. Analysts like RHB have internalized this confidence. They've lifted their future dividend per share, or DPS, estimates by a substantial 33 to 34%.
That is a huge forecast change. What kind of payout ratio are they expecting now?
They're anticipating a return to a higher payout ratio of around 24.5%. Now, you compare that to the much more cautious 21% they paid out in FY24.
So it's a signal. A return to the philosophy we saw back in, 22 and 23.
Precisely. And for the listener who's focused on yield, this creates a very attractive forward profile.
What are the numbers looking like?
RHB is projecting yields of around 6% for FY26, while TA Securities is estimating 5.5% for FY25. For a company of this quality, those are strong yields. They really underpin that recent price movement up to RM 19.50.
And this confidence, of course, translated directly into analyst endorsements. Give us a quick summary there.
The consensus shifted strongly positive. RHB upgraded the stock from neutral to a decisive BUY. They lifted their target price to MYR 21.4U.
Which implies what kind of upside?
Well, even after you account for a 6% ESG premium they include, that still implies a significant 15% upside from the price when the report came out. TA Securities also reiterated their BUY rating with a target price of RM 21.20.
Before we get to the moat, just a quick note on management. Stability seems to be a key theme, even with some recent leadership changes.
Absolutely. The appointment of a new CEO for ALIM and a new group CFO prioritize what they call homegrown talent. This is a deliberate strategy to ensure continuity.
The message is clear. The current plan is working, and they're not going to mess with it.
Exactly. They're also very explicit that their capital and solvency buffers are fundamentally stronger now than they were during all that regulatory uncertainty a year ago.
Okay, so let's get to the structural strength of the business, the moat. We've consistently rated Allianz highly. We gave it a financial moat scorecard rating of 8 out of 10. Given all this success, does that score hold steady, or should it maybe be higher?
The score remains a very consistent and a very robust 8 out of 10.
Okay.
The performance in these last 9 months didn't necessarily widen the moat, but what it did was massively reinforce the existing foundations we'd already identified.
So how does this latest report really cement that 8 out of 10 score?
Well, it reinforces those two key operational pillars. First, scale and market leadership. You see that with AGC capturing 46% of the motor market growth. It proves their size isn't static. They're actively using it to gain share.
And the second pillar?
Operational discipline. That's proven by the successful rollout of the co-payment policies in the life segment. They use strategy to drive margin expansion and, mitigate a huge macroeconomic risk.
And those foundational elements, the things like regulatory hurdles that keep new competitors out and the strength of the global Allianz brand, those are still powerful protective barriers.
Precisely. Those foundational barriers protect long-term profitability. But, we have to acknowledge the challenges that are still there, the things that prevent the score from being a 9 or a 10.
Right. So what are those ongoing complexities we should still be keeping an eye on?
The need for a Takaful presence is still a gap in their portfolio. Allianz is still looking for suitable M&A opportunities in that space, but the key phrase they use is economically viable.
Meaning they're not going to overpay?
They are not going to overpay just to tick a box. Any M&A deal that materially affects their capital position, especially now that they've committed to a higher dividend, that's going to be a very tough balancing act.
And their strong ESG score was noted, particularly governance.
Yes. The overall ESG score is very strong at 3.3 out of 4, and the governance score is excellent, a perfect 4.0. And while this is a positive, maintaining that high standard requires constant strategic alignment with the pretty demanding oversight of the parent Allianz Group. It's an ongoing commitment.
So, to synthesize this whole deep dive, Allianz delivered a massive 9-month beat. It was driven by disciplined underwriting in both general and life. They successfully tackled medical inflation.
And all that success has given management the confidence to go back to a higher dividend payout philosophy. The market saw that shift and reacted immediately.
The regulatory and operational fog has really lifted, revealing a company that isn't just weathering the storm, but is actually using strategic moves to gain a real market advantage.
That's a perfect summary.
Excellent. So this brings us to our final provocative thought for you to think about as you watch Allianz's trajectory from here. Management has gained the confidence to commit to a higher dividend payout ratio, moving back to that 24.5% level. This is fantastic news for shareholders now, but it dedicates a larger portion of their earnings to distribution.
So the key tension is this. Knowing that this new higher dividend places increased pressure on continuous high-quality earnings, how much capital risk are they willing or even able to take on for future strategic initiatives?
Specifically, those economically viable M&A deals in the Takaful space, or the need for major digital investment to ensure they dominate the market in the long term.
That's the question. The commitment to reward shareholders today might just constrain their options for tomorrow's essential growth. And finding that balance is the central focus for their leadership going forward.
Absolutely. Well, thank you for joining us on this deep dive. We truly hope this exploration gives you some valuable insights for your own decision-making.
We hope so.
And if you enjoyed this level of analysis, please be sure to like, comment with your thoughts, or maybe any stocks you'd like us to cover next, and of course, subscribe. Until next time, stay well informed.